All right. So thank you, Ben, for being here. I'm Charles Rumberger. This is my 21st Century Expression podcast. Um, Ben, thanks for being here. Could you introduce yourself a little bit? Tell us a little bit about yourself.
Sure. Yeah, my name is Benjamin Quaye. I grew up in New Jersey, went to Rutgers class of 2012. After school, I ended up working in a couple boutique investment banks in New York and did a couple projects in mergers and acquisitions, fundraising, strategy, evaluation, and got to meet a lot of startups. And then I ended up taking a job at Boom Financial in 2014, and since have been in the fintech sector. And last year during the pandemic in 2020, I went ahead and started a fintech startup myself called Clowte. Both my two other co-founders also went to Rutgers, so definitely happy to be here.
Awesome. Yeah, thank you. I really appreciate that. So today we're going to be talking a little bit about access to credit, specifically for people who have a little bit harder time getting it, and possibly some solutions and effects of it as well.
Cool.
Let's try and dive into this and outline the major problems we're looking at here. We'll just look at some statistics. Maybe we can kind of lead the conversation from there. Generally, you start to think people, particularly lower income or people of underrepresented communities can have a lot of trouble securing credit, right? Gaining access to traditional financial services. A Consumer Financial Protection Bureau study found in 2018 that 15% of African Americans and Latinos are entirely credit invisible. So I want to kind of get some of your insights here. And where do you think this stems from, and what does it equate to? What does it lead to?
Great question. One of our investors actually was the former senior advisor to the director of the CFPB. So we've definitely tried to do our homework and learn a lot about this subject in general. So it's a small world. I think there are really three major reasons why we see, just this credit invisible, thin file, no file problem. It's really that folks don't have control of their own data. So Europe has gone to the direction of like open banking and open finance and things like that. So you're seeing regulations like GDPR and PSD2 and things like that, which actually opens up just like a control of data to individuals in a more heavy way. California has passed the California Consumer Protection Act, Privacy Act, and that is right now like the only legislation that actually mirrors something similar to GDPR in Europe. And that's really one of the biggest issues. Is this collectively, we just don't have a regime that puts people in control of their data in general. So you can't impact your credit score. You can't impact your credit score in a way that you want to. You're at the whim of, kind of just these consolidated, siloed off data sources or data collection sources. And societal, just like systemic societal biases and prejudices. So, for instance, minorities, Black people, women, a lot of folks just, they have lower incomes. So if there's a bias against income creation, then you're not going to be able to support, debt and interest payments as easily as someone who's making more money. So there is just this like lack of diversity and inclusion in a lot of our institutions that causes, makes it more difficult for folks who are in marginalized groups to even have the income to support debt and interest. So if you can't support debt and interest because your income is lower or you're getting fired more rapidly or something like that, then your credit score will be lower. And that's just inherent because of the societal prejudices and biases. Women make, 70 cents on the dollar compared to men. So men are more likely to be able to support debt because of that inherent bias. So until we address some of those things, like that, the credit score will just reflect our own, subconscious and conscious biases. And lastly, honestly, incumbents have no incentive to innovate. They're making a lot of money. The system works for them. So they don't have any incentive to change anything. We have this bifurcated kind of financial system where you kind of have prime and subprime. So like, a lot of the banks, they focus on high net worth individuals or higher income individuals for a reason. They make money off them. There's no reason to change that profitable business model. many folks who are lower income and in these marginalized groups rely on money services businesses, money transmitters, alternative finance, things like that, and they're making a lot of money. So this system really like hasn't it's bifurcated and really hasn't there's no financial incentive for the incumbents to actually fix anything.
Mhm.
So those are the three main reasons that that I've seen out there that seem to be the culprit in terms of getting us to where we are today.
Yeah, awesome. That was a really awesome answer. Like some of the things you mentioned, specifically one thing I think with this research project, what I've looked into focused a lot on the history aspect. I think your company Cloud also, in a way, kind of touched on that because there's ways to address, that lack of history that may lead to a lower credit score. Before we talk about some potential solutions or paradigms, different things going on, I want to kind of dive into the effects of this, like what it means for consumers. So we're talking, some of these people are unscorable. They were unable, and this has led to the Federal Reserve Board of Governors in 2018 put out a study that same group, 30, but this time 32% of African Americans and Hispanics, well, 32% African Americans, 20% of Hispanics had no access to a credit card. So you're saying you kind of led about some of the things you said that may cause this. What effects do you think this has, like in general, when someone's unable to secure things like credit cards, car loans? What is this? How does this affect the people themselves and the overall economy? If you want to touch on that a little bit as well.
Sure. Yeah. So I can go into a little bit of the founding story of Clowte, my startup Clowte.
Mm.
So me personally, like when I was a freshman, I couldn't get a student loan.
Mm-hmm.
So I was 18 years old, and half my tuition, was covered by financial aid, and the other half I could not afford, and I could not get a student loan. So I graduated high school in 2007. Credit started to freeze up. The financial crisis was creeping up, and every student loan I applied for, I was denied. And I had to get my parents tried to co-sign. Like my dad lives in Florida. My mom grew up with my mom in New Jersey. Asked both of them to co-sign, still being denied. Asked relatives, denied. And finally, I went to the registrar's office, and there was like a loan that was, if you basically just show evidence of denials, you get this loan, and that's what I used throughout college to pay it off. So right then and there, there are a lot of organizations that help folks from marginalized groups kind of get into college and be a lot more represented on campuses. But the first generation college students actually drop out 85% of the time, there's really it's challenging to stay in.
Mm-hmm.
So my experience, I didn't know how to get the loan or cover the expenses or cover the tuition. So I was on campus and I was getting my syllabi, buying my textbooks, and I didn't have my tuition paid. So they send you notifications saying things like that. If you get deregistered, it's hard to re-register past those deadlines.
Right.
So this is like a blocker. Like getting a bachelor's degree is like one of these moments in life where you dramatically increase your capability, your capability to increase your lifetime income. And if you can't get a student loan to do that, to stay in, to afford it, you won't get that, you won't achieve that upward mobility.
Mm-hmm.
So like it's a blocker, and this dramatically impacts folks who like are from these marginalized groups. Your first person in your family to go to college, you're an immigrant, like other types of minorities, obviously. So it's crazy because if I hadn't had like just asked like for help and received it in terms of like just give us like, I don't know, it's like I had to show them like 5 denials and then they gave me this loan. I would have never I arguably, if I'd waited a few more weeks, they could have just deregistered me from all my classes, and at that point you're effectively like dropped out. You dropped out of college. So that's one story. My co-founder, he also went to Rutgers. He was on the football team, and he graduated and he got a job offer from Goldman Sachs. His name is Miles Jackson. He got a job offer at Goldman Sachs, and he's trying to move to New York, and he's being denied apartments. So landlords in New York and in San Francisco, all these competitive, real estate markets, they check your credit before they let you live in or rent from them. So he was being denied. He's like, well, I had a football scholarship. And so I didn't take out a student loan, and I didn't need credit cards because, fortunately I did everything right up until that point in terms of, being a model student athlete and things like that. But because he had no credit history, he was being denied apartments in New York. So if he couldn't have gotten an apartment, he had to put up like a large security deposit. Someone gave him, like I don't know, most deposits like a month and a half. He had to put up like I don't know how many months up front to get a place close enough for him to commute into the office. So if he couldn't have gotten an apartment and he had to commute from farther, he would have had to make the decision to either not take that job, or having a long commute distracts you from your work and you might not perform in your job as well. So these kind of things just, and this is like a great job. Goldman Sachs, everybody wants this job. It's high paying. You're at a very prestigious firm. It sets you up. And if you can't take that opportunity, like again, your ability to maximize your income over your lifetime is dramatically reduced. And this is stuff that, again, is adversely impacting minorities, marginalized groups, people of color, women, other, like immigrants, things like that. So in these two situations between myself and Miles, we came together where we're like, we have to solve that. And that's exactly what happens. You can't get education, you can't get insurance, you can't drive because you can't get car insurance, and you can't drive to your job because you don't have a car. Over time, you're just not going to be, in the most well-to-do financial situation. And that just compounds and it becomes generational and it just gets worse and worse. So the system is not designed to actually allow folks to achieve upward mobility. Us at Clowte, we're building API infrastructure. And one way we visualize and illustrate this is like a ladder, and there's like a gap in the middle of the ladder. Mm-hmm. So if 130 million people have below average credit, and like 40 million plus have no credit invisible, like you said. So it's like if you're at the bottom of that ladder and there's a gap, most likely you're not going to be able to get across to the other side. And like at the other side, at the top of the ladder, is the American dream: homes, school, cars, and being able to be mobile and like just afford these things. And this is just adversely impacting marginalized groups, and it's impact of your credit score can have, so like if it's low or thin file, no file, whatever it is, it just blocks you from achieving upward mobility. And then you get regulated to the alternative systems, which are way more expensive, sometimes are usurious, and can be predatory themselves in terms of like the alternative financing that we've seen in the past. Mm-hmm. So it's a crazy. The system is like really just not designed to help folks go from point A to point B. It really just helps folks stay in point A or stay at point B.
Right. So that's a really interesting answer. Talking a lot of really interesting stuff there. One thing I particularly looked into, I think when people are unable to, you had your personal stories. A lot of time people are unable to secure credit. One avenue some people tend to go to is less reputable, arguably predatory lending services, namely auto loans or like title loans or payday loans. Mm-hmm. And a quarterly Journal of Economics review in 2011 discussed these, showed that these short-term high-interest loans do little to actually facilitate financial stabilization for borrowers, and can actually place them in a worse off position if they did not utilize them, given they have extremely high interest rates, up for sometimes 300-400%, and fee structures that are a little confusing and expensive. So when people are in such a pinch, why, if we can talk right now and say, oh, it's so bad, you should not use this, why, when people are in a pinch, do they find these loans so attractive, and why are they problematic overall? Or why?
That's good question. I mean, like there are poverty traps. There's a great book. I think it was MIT economists. They wrote this book called Poverty Inc. I'll have to double check and I can get back to you on the exact name of the book. Poor Economics, it's called. Poor Economics, Poor Economics. And the sophistication that this study found of folks that were living on $1 or less per day, the sophistication of their financial like literacy, they were quasi like as sophisticated as hedge funds who had lots more capital.
Mhm.
The problem that they faced, or the study found, was really that, like, like if someone broke a leg, or like, you had to go to the hospital, or you got fired, you got, there's some shock, like the COVID, some shock. Whenever that shock happens, you're essentially in a poverty trap, and that's what causes like this generational perpetual poverty.
Right.
So like in that moment, when you're facing a poverty trap, in that moment, you have no choice but to take a payday loan. like
Right.
you literally have, yeah, like you're gonna, if you break your leg and you can't afford the hospital bill, there's nothing you can do besides take the payday loan, like literally.
Mhm.
So like like I don't think people are making a conscious decision to do this. If there were alternatives, they wouldn't take it. But again, the system is not designed to like help folks get from point A to B, from point A to point B, or from 0 to 1. It's just designed to keep the system bifurcated. So like the folks doing the payday lending, like the banks have pretty much surrendered that business to the payday lenders, because they don't see it as viable for them. Like it's not that they don't see it as viable, they're not good at it.
Mhm.
So like the payday lenders are good at payday loans, and the banks are good at normal loans. So
Right.
like they decided to split that up and divide that market up the way they've divided it, and it's working very, very well for them. And like if the individual who is reduced to using these potentially predatory forms of finance, if they had other options, they wouldn't do it.
Right.
And that's kind of where we are. Like it's just literally folks have no choice but to do it. Like there's some distrust with the system, and folks potentially distrust some of the current actors in the system. Banks have been here a while, corporations have been here a while, and there have been stories. So some folks are a little bit averse to working with them anymore. I mean, there's like a lot, just a distrust in some of these institutions. So we have to reestablish that trust before, like some of the folks that potentially, like, I don't think folks who are using the alternative finance aren't doing it because they distrust the other system. They're doing it because they have to. Meanwhile, you have folks who don't need the predatory system, the predatory lenders, or the alternative system, and they're just refusing to use the existing one because they distrust it. So that trust has to be reestablished somehow. I think you're seeing a wave of fintech kind of fall into that bucket where the mistrust is, or the distrust is. They're able to take that market a little bit,
Mhm.
but it's really a UI or a UX layer over top the legacy system. It's not much different. It's just a different brand, and you don't associate some of the past behavior with these newer brands. So that's kind of how it seems like, at least from my opinion today, is that there's use alternative finance. If you fall into a poverty trap, like you get your job does layoffs, you break your arm, or you can't work, someone passes away, or like my mom's from Haiti, my dad's from Ghana, and I've seen folks, lots of folks, they use agriculture as their like, as basically as a bank account. So instead of keeping cash, you buy a goat or something. If that goat dies, you just wiped out all your savings.
Right.
So
Right.
these are like little poverty traps that happen in different ways around the globe. And if that poverty trap happens, then you're reduced to using the alternative finance, which could be predatory.
Mhm.
And then the other option, the other problem is that folks are choosing not to use legacy brands and businesses because they don't align. They don't feel that those brands are aligned with their view of the world and their morals and values and things like that.
Yeah. Yeah. Definitely makes a lot of sense. One thing you really mentioned was the system. You mentioned how the system tends to keep people one place rather than offering upwards mobility, which would be the goal. It's very easy for me to say in grandstand and tell you all the things should be like this, things should be like that. Um, but I think a more productive thing could be to discuss what are some potential solutions and how could they make sense. So the CFPB, again, when discussing these payday loans, later in the publication mentioned, um, not in these exact words, but things like paid utilities, insurance, payday loans themselves, car title loans, paid bail, non-delinquent medical expenses, all these
Mhm.
things. And you even mentioned recently potentially subscriptions. Uh, Most of these things generally, if unpaid and sent to collections, could have a negative or adverse impact on someone's credit history and overall financial well-being. So, how do you feel about these things, which could hurt the score if unpaid? How do you feel about that potentially being incorporated into scores if they are paid? All these alternative data points that we think about. How do you feel about those kind of being used to show someone's financial history over time if they're paying off, their insurance and rent every month? And there are some startups doing that, but what are your general opinions on it?
So let me just clarify the question. So it's I guess the question is what are my views on like alternative data sources, and
Mhm.
then like maybe what is the risk associated with the adverse impact of those alternative data sources?
Yeah, yeah, certainly. Go with that.
Gotcha. Okay, great. So one, I think we tell ourselves this lie that bank loans are the only form of credit out there.
Mhm.
Credit is really, like someone's willingness to pay. So like if you're willing to pay for anything with some I guess expected frequency, that's credit.
Mhm.
So if you don't pay it, it will inherently go down. You'll lose credit essentially. So I think like we have to, as a country, as a system, we have to kind of all agree that like if you agree to make a payment on a monthly basis, you should make that payment.
Mhm.
The system, the infrastructure will be designed to reward meeting that obligation and being willing to meet that obligation, and it will disincentivize you to not do that. So if you opt into that system, it can benefit you, and it can, and if you don't, like if you try to go against it, it can, it'll be reflected. That's my, like I want to build infrastructure that allows credit to be, more pervasive, and that just means that if you pay, you get rewarded. If you don't pay, you get dinged.
Mhm.
And it's not a one-way street. You can't have your credit go up and never have it go down. Like if you miss
Yeah,
a payment, it's going to go down.
right.
So a lot of the alternative credit that we've seen out there is data that is a demonstration of ability to pay,
Mhm.
but without that second street of, or the second lane of it going down, it's not really measuring your willingness to pay. So I think that alternative data can be powerful, but it can't just be like data collection, like data points that you paid. It has to be some kind of credit event that is associated with those payments. So like Cloud, our APIs, like we effectively turn any purchase into a credit event. And what we say by that is that you're paying for a subscription anyway. Right now, it's not a credit event. Companies that are selling goods and services in a subscription business model can work with us and turn those into credit events.
Mhm.
In that case, if the person pays, they're rewarded. The business, can increase their retention and their lifetime value per customer because the person's paying and they're getting the added benefit of their credit going up. So that incentivizes the right behavior. If you don't pay, it will go down. But like you have to like, like make it's all about willingness. So like if you call somebody and say, look, I can't pay this month, or I'm going to be a couple weeks late, that's different than just outright abandoning. And we, like our goal over time is to allow people to really demonstrate their willingness to pay and have businesses aligned with trying to, I guess like work with folks. So like right now it's like a zero sum game, and businesses that are charging on a recurring basis just have to collect. They don't care how to collect from you. And if you don't pay, they just run. They're willing to just like be like, you're a bad customer, never talk to them again.
Mhm.
That's a zero sum game then. So like we want to change the incentives to, to have folks pay these recurring payments down in a way that's where all incentives are aligned essentially.
Yeah.
And it seems like the credit scoring system could actually be designed be the layer that actually provides that. Like us, like we're starting with subscriptions, but we really do see a world where any recurring payment can build credit. And then potentially, maybe there's some, like 10 years out, if there's some, changes to the way, we regulate this stuff and, make these credit lending decisions, there's potentially a way where like recurring behaviors could be a credit event. So like I go to Whole Foods, I live not too far from Whole Foods. I walk there pretty much like every day, at least once, and I buy something. Potentially that could be a credit event. So like it's not today, it's not like a subscription, but potentially one day that could be the case. We've seen this in emerging markets that don't have like established credit systems. Like where they, if somebody is going, I think they just track your GPS. Like there's a company that just tracks your GPS. They see you're going to school every day. That kind of increases your credit.
Yeah.
Versus if you're going to the casino every day, then like that would decrease your credit because you're like they can extrapolate from that data that your income is likely to go higher if you're going to school every day versus going to the casino. So like that is highly difficult from a regulatory perspective in our current system today. So we couldn't do that.
Right.
But within reason, in years out, if regulation goes that way, potentially like we could reimagine the way the credit system works, that could potentially be integrated. So I think it starts with subscriptions, then like all recurring payments, rent, tuition, utilities, things like that. Then potentially like this other kind of behavioral way too as well. That's definitely a moonshot in the United States at least. But there are different ways to reimagine it, and I think we're getting there now, especially since 2020 was such a crazy hectic year. It's like folks have the will and the appetite to reimagine this. The credit bureaus didn't even have the trade line was really created, I believe, in 2015. So the CFPB's guidance on these alternative data points kind of nudged the system in general to start even considering these. So as like these new alternative scores get more widely used by lenders, you can see an uptick. That's still probably like 5-10 years away. Like there are these newer credit scores that incorporate these things. The older credit scores don't as much. So if there's not mass adoption of these new trade lines or if there's no mass adoption of these new credit scores, then you're just surrendering your data versus like actually getting access to more credit products.
Yeah, that's a really awesome answer. We're really looking at some major paradigm shifts. It seems like things changing, and it's pretty exciting to see, I guess.
Absolutely.
I really liked how you already kind of covered my next question, which was going to be about what does Clowte do and how do they seek to address some of these issues. But another thing I kind of wanted to bring up was how do we get, as you said, commercial clients interested in partnering with startups, things like Clowte? How do we get them interested in this overall ESG, I guess you could consider it ESG area? I read recently an asset securitization report in 2015 showing there is a $2 trillion in unrealized potential purchasing power for Hispanic lenders in America that is not fully realized or appreciated because perhaps they don't have enough access to credit or they're not able to deploy it effectively. We see numbers like this, and we also see banks trying to increase their ESG metrics, the way that their portfolio looks, how does it affect those around them. So how do you think about what do people need to be doing, companies need to be doing, or how do you even think about getting lenders and commercial partners interested in kind of being interested in the alternative credit data and these different things?
So I'll go a little bit into like Clowte a little bit, and then I'll segue into the second answer. So when I worked at pretty much all API infrastructure, like financial infrastructure companies. So like, there are these core processors that process payments, and they open up accounts, and they issue cards. That legacy, like fintech is old. Like Visa is a fintech company. WorldPay and Vantiv, or they bought Vantiv, but and First Data. These are all fintech companies.
Mhm.
Their technology, the technology available has outpaced their ability, their innovations. So these fintechs are now being able to build some of these things out into more modern software languages and data schemas and things like that. So that's the fintech opportunity at the infrastructure layer, and that's kind of where we sit. We build an API layer over, like in the credit reporting system. So like we're a registered data furnisher with the credit bureau, Equifax, and we are trying to make a sleek software stack that basically plugs us into the legacy infrastructure. And that's at its core what, one of the biggest API, or I guess fintech infrastructure opportunities. It's like there was a wave of, let's build infrastructure to open up accounts better. Let's do infrastructure to verify identities better. Let's develop infrastructure to issue cards, process payments. And the last part is really that credit and lending component of it. And we're just now seeing this, kind of sprout up now. So like we're playing into that wave a little bit. And I think as that happens more and more, more other companies will start, if we build this infrastructure out, what are the use cases for it? And that's the interesting thing. It's like, once you, if you're building a bridge, there's no reason being concerned with the make and model of the cars that are going to drive across the bridge.
Mm-hmm.
You just need to build the bridge that can get cars from point A to point B. As cars start driving across, you can start, like there's a toll booth, you see the camera, you start seeing the make and model, and you can, start understanding more about the profile of the cars driving across.
Mm-hmm.
But that's what's so amazing about the API model, at least from our perspective, is folks come to us with their use cases and their problems, and we can use our API to be the solution for their problems. We don't have to make them up. Mm. And over time, we'll start to see more and more use cases. And I think as that last wave of credit and lending infrastructure gets built more and more out, we'll just be more exposed to it, and like people will say, oh, that actually solves my problem. Like I think that is what will cause like adoption, essentially. Is like really, like we collectively have to like reimagine the way it works. And as that reimagination is happening, it's talking to folks like you and just like telling them, here, this is available and here's where we're going. Now, how do you think this can be useful to you? Because like I was saying, like incumbents and legacy companies really have no incentive. So we have to identify those incentives,
Right, yeah.
And some of them have not even presented themselves yet. It's a work in progress. Like for us, like we've noticed that, the credit like scoring creates an incentive for a business, because that it can increase lifetime value for their customers. It can drive conversion for new subscribers. It can, help them with marketing and ESG, like you're saying, to have a better impact associated their brand with it. So these are some of the use cases that we found for it. And like we've even talked to companies large insurers who are, denying people for insurance, and they want to like make paths to getting insurance. So like they're like, people are coming sitting in a room and making them up. Folks are telling us their problems, and we're able to identify ways that our solution can solve that problem for them. And that's once the infrastructure is built, it's like we just have to be on the lookout for like ask people, how they feel, like what keeps you up at night when you're running your business, and we can figure out ways that this API and the infrastructure layer can be useful to them, and that's how you incentivize. You align everyone's incentives, the end user, ourselves, and the legacy companies and the banks. You align all those incentives to nudge the world to a net positive impact versus just kind of saying, all right, well, this is working, and we're going to leave it the way it is.
Yeah, definitely. I really liked you mentioned the word reimagination. It seems like the most powerful thing to think of now. We're looking at the overall system, and as you mentioned again, like the incumbents and their current practices, and trying to reimagine how we can look at things in the future, where we can go from here, right? So I know you could probably talk about this forever. You get all nuts about this, I'm sure, but due to time constraints and respect for you, we want to start wrapping up a little bit. Generally, I thought this was a really awesome conversation, so thank you very much. I really like to think about how it's good to know that people like you are out there working on problems like this, because it is a problem that we all see, and it's one that is there, prevalent. We discuss it a lot, and it's exciting to see some of the upcoming changes and how it will affect people from all different backgrounds, right?
Exactly.
So before we wrap up here, though, I'd like to ask if anyone's listening to this and wants to know more about Clowte or you, like, is there anywhere they can reach out, any resources they can check out, or just
Absolutely. Absolutely. One thing that I've always done, even when I was at Rutgers, I would reach out to alumni and a lot of them respond. So I'll just go ahead and say my email is ben@clowte.com. Anybody listening, especially fellow scroll at night, like, please feel free to email me. Cloute's website is www.clowte.com. You can follow us on Twitter, Facebook. I think we're on IG, LinkedIn, and things like that. So you feel free to connect, follow the company, follow us, myself, Ben Quaye, and Miles Jackson, and Ahmed Khalil. We're all part of the Rutgers community, and we're here and ready to connect with anybody.
Yeah, that's awesome. I'd also like to mention on your website, you can, if anyone's listening to this, you can access the Medium posts, because I think there's pretty good ones on there.
Yep, we have the blog too as well. Yep. We'll be writing more and more on that as we go. We've been we're in interesting times where we've been prioritizing business development and fundraising and things like that. So it's a fun time for the company. We incorporated last May. So we've reached 1 year old right now, and it's fun stuff. But definitely do tune into the blog and follow us on all social media and reach out. Again, email is ben@clowte.com, and happy to connect with anybody.
Yeah, sounds awesome. All right, well, thank you, Ben. And
Absolutely.
the end of the